All right. What I wanted to go over is how almost everything is a cash equivalent. Okay. So when it comes to receipts, when it comes to cash, when it comes to promissory notes, when it comes to court cases, the bonds and everything are cash equivalents. So sometimes people do not get this. And, if you don't understand this, this is why your court case is actually a tax case. So, some people understand that municipal bonds are not taxable. Well, under federal tax law, municipal bonds can be taxable if you report them as cash equivalents or under United States federal tax law. And you know how people say, I'm not a tax professional. Woo, 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 this is not legal advice. Okay, all that bullshit. Okay. Under the doctrine of cash equivalence, the doctrine of cash equivalence states that the United States federal income tax treats certain non-cash payments transaction like cash payment transactions for federal income tax purposes. The doctrine is used most often for deciding when cash method as opposed to accrual method. So the accrual method is the basis of accounting is the time various financial transactions are recorded. The cash basis and actual accrual basis are two primary methods of tracking income and expenses in accounting. Okay. Taxpayers are to include certain non income items. Another doctrine often used when trying to determine the timing of the inclusion of income is constructive receipt doctrine. Now, if people remember back in the days, I told you what a constructive receipt is. I'll go over it again. For federal income tax purposes, the doctrine of constructive receipt is used to determine when a cash basis taxpayer has received gross income. A taxpayer is subject to tax in the current year if he or she has unfettered control in determining when items of income will or should be paid. Okay, so I'm not going to go into that too deep. So most individuals begin as cash method taxpayers because of their first form of bookkeeping is checkbook. So like when a bank receives a promissory note, a court receives a draft or a note, this becomes a cash equivalent. Okay. But what they do is they defer it off to a year from reporting off to a year. Okay. Technically, they're supposed to report it within 30 days, but I'm not going to get into that in this video. In contrast, some businesses start as an accrual method taxpayers because of the businesses use different rules for recording income and expenditures. The Internal Revenue Code, the IRC subsection 446A states, however, that taxable income shall be computed under the method of accounting on the basis which the taxpayer regularly computes his income in keeping his books. Now, what people do not understand, one of these days I'll do a video talking on how you can actually choose the way you do your taxes. So the IRS cannot tell you how to file your taxes. They cannot tell you to account for your books. Your books just have to balance. Okay, one of the major advantages of the cash method of accounting is the availability to defer taxation because the sorry, I got distracted. Recognition of income applicable to amounts in accounts receivables can be deferred to a later year. The doctrine of cash equivalent is important because many people are cash method taxpayers and will be subject to the rule. Now, I'm using the reason why I'm using Wikipedia is to make it simpler for people who do not understand tax code or how to to read it or understand it. Because reading Title 26 can be a nightmare for most people if you don't have a high level of reading comprehension skills. And there's nothing wrong with that. We all have some area that we have to build. Okay, cash method taxpayers include income items, cash and cash equivalents. Okay, in the year the items are received. See also Treasury regulations. Certain payment transactions involve cash equivalents, such as receipts. Such as receipts of checks and credit card payments. So when you pay a credit card payment, you are supposed to receive what? A tax credit. It doesn't matter if you're a business or not. By making a credit card payment, because your credit cards are prepaid, when you make a cash payment or you pay out of your account, it is considered a cash equivalent to on their books. So you're supposed to report all your credit card payments and you're supposed to receive a tax credit. This is why I say that you have the ability to offset or discharge your credit card. So technically they can't bring you into court because it's unjust enrichment. Yeah, because it's an unsecured account. Okay, the cash equivalent doctrine arose out of the need to determine whether certain items that were either actually or constructively received must be accrued as income. A dispute over the timing of income recognition for tax purposes may arise when the thing is received. The thing received is really not much more than the promise of a payment. Okay, let me go over that again. A dispute over timing of income recognition for tax purposes may arise when the thing received is really not much more than promise of payment, such as a promissory note or a bond. Okay? If mere promises to pay were considered cash equivalents, then there would be little difference between the cash accrual methods for tax purposes. So this is established by the United States Fifth Circuit Court, established the standards for applying cash equivalent to promise the payment. Okay, so you need to know this. The court first noted that the principal promissory note negotiable form is not necessarily the equivalent of cash remains true, but the principle also has a true inverse that a non-negotiable instrument can be a cash equivalent if the following factors are met. A promise to pay will be considered a cash equivalent for cash method taxpayers. Now, let me explain something to you. After I read this, I'm going to go back and show you that a note or a promissory note is a non-negotiable instrument. Okay, so a cash equivalent for cash method taxpayers, if the promise to pay is unconditional, the promise is made by a solvent person, the promise is assignable. Okay, the promise is assignable. Don't they assign notes? The promise is not subject to set-offs, and the promise is marketable. Okay, a promise to pay is considered a cash equivalent for cash method taxpayers if the promise is to pay is unconditional. Now, for the people who took my my law class, we went over conditional and unconditional promises, and we went over that and to show you what a conditional and unconditional promise is under Title 26 of the law. Now, I know most people do not understand that, so I didn't go that deep to break down tax law, going into all the statutes and citations and all this. I don't want to get that deep with most people. I just want them to understand the general principle. So that means your mortgage note is tax deductible. That means your car payment is tax deductible. You see all these people talking about, oh, you have to have uh, uh, all you have to have a certain weight of your vehicle for it to be a write-off. No, that's not what the Fifth Circuit says. The Fifth Circuit says that the promise to pay is tax deductible. So this is basically telling you this. So a non-negotiable instrument, mortgages are non-negotiable instruments. Okay, a negotiable instrument is a document guaranteeing the payment of a specific amount of money either on demand or at a set time whose payer is usually named in the document. More specifically, it is the document contemplated by or consisting of a contract. Now, notes, mortgages, and drafts are not negotiable because they do have those elements, but they are really securities. Okay, since taxpayers generally prefer to defer recognition of income to subsequent tax years due to the value of money, and finding a cash equivalence will typically be to the disadvantage of the individual taxpayer. Not really. Now, if you understand how to file taxes and certain exclusions, you will understand how to get out of this. And you would actually want to get your taxes done quickly. So then you can get that off your books. But I'm not getting into that now because I can show you how to get everything tax free. It doesn't matter. To use the doctrine of cash equivalent, a taxpayer must have either actually received an item or constructively received an item. So if they constructively receive it, meaning your pay stubs are constructive receipts because they're evidence of an event taking place, but the tax is deferred to the end of the year because you never really get paid from your job. Okay, you get credited from your job, but you never get paid. Okay, so that's what constitute your pay stubs are what constitute as constructive receipts. So I'm going to go back into constructive receipts and let's go to that real quick so you guys can see that. I want to make sure my page is sharing that. Yes, constructive receipts. Okay, for federal income tax purposes, the doctrine of constructive receipts is used to determine when a cash basis taxpayer has received gross income. So when you're credited from your employer, that's what they consider is gross income. Okay, so a taxpayer is subject to tax in the current year if he or she has unfettered control in determining when items of income will or should be paid. Now, I know you think you don't, but you do. So you can read a W-4V and you'll understand that all taxes are voluntary. Okay. Unlike actual receipt, constructive receipt does not require physical possession of an item of income in question. This is why all the banks or this is why all employers usually select direct deposit. Well, there's some benefits to direct deposit in wiring money on their books. So they defer the taxes to you, and that's why you pay income taxes because it's considered a gift to you. Okay, so we went over that, the mechanics. Okay, so I'm going to end this video. I was just testing this out to see if this works, but yeah, so remember, anybody who has constructive possession of your note, your deed of trust, your title, they are all taxpayers, and it's up to you. Okay, it's up to you to settle all your accounts. Okay, to use the doctrine of cash equivalence, a taxpayer must either actually received an item or constructively received an item. If either of these situations exist, a taxpayer must determine whether the item received is a cash equivalent using 6 factors described in Cowden versus Commissioner. So look up that case. If the item is deemed a cash equivalent, the taxpayer has income, meaning the corporation. So if you make a credit card payment, you must write off all your credit card payments because there are cash equivalents on the books of the facilitator of credit. And they'll defer it to the person who really receives it, who's probably the DTCC. If it is not a cash equivalent, the taxpayer does not have income. All right, so I thought this was a good video to go over to kind of give you guys a little insight about what is cash equivalent and what is not. I am out.